Leslie Preston will join us for the annual economic overview. Leslie is a senior economist with TD Economics and has over 12 years' experience as an economist. In her current role as senior economist, Leslie works on macroeconomic forecasts and current analysis for the U.S. economy. We're not only pleased but fortunate to have Leslie with us today. And I'm sure with all the things that are going on in Washington and around the world, from Brexit to the trade wars, the government shutdown, there's got a lot of stuff to talk about. So Leslie, please join us.
Yeah.
Sorry, looking the other way.
That's okay.
Thank you so much.
Sneaking up behind you there is a little unfair. So it's a pleasure to be here this morning to talk to you a little bit about where we at TD Bank and TD Economics see the global economy going over the next couple of years, and more specifically, where we see the outlook for the U.S. economy. Now, I'm up here for about a half an hour. I did leave a little bit of time for questions. I would say, I too have not spoken to such a huge room with everyone in one place before, so if anyone is brave enough to raise their hand in a room this large, a bit of time for questions at the end. So as I say, I'm going to review, go over the global outlook over the next couple of years. Now, I know my colleague James Marple has spoken to this conference in the past, and James is an excellent speaker, and I recognize, I have some pretty big shoes to fill on that one, but I will take a page out of his book, and I know he often reviews what our outlook was the year prior and talk a little bit about how we did, what went the way we were expecting, and what were some of the surprises. So looking back at some of the things James talked about last year in terms of themes, I actually think we did pretty well over the past year. James mentioned that equity markets seemed a little bit optimistic. There was a lot of ebullience in equity markets, and that the bond market was sending a few more cautious signals. We certainly saw that optimism reverse in the fourth quarter of this year as equity markets come to terms with an economy that is slowing. He talked about how the American economy was set to grow above trend, above its potential growth, and that household spending and business investment would be supported by the tax cuts. And that came through in spades over the past year. In fact, the U.S. economy outperformed our growth forecast for the first time since 2009 in this cycle. James talked about how the unemployment rate would be difficult, particularly here in Maine, to fall much farther, and that there would be upward pressure on wages with such a tight labor market. And through the course of 2018, we did finally start to see a bit more upward momentum on wages. The unemployment rate did fall a little bit further here in Maine, particularly through mid-year, has backed up a little bit, but overall unemployment remains very low. We expected inflation to move marginally higher, and indeed it did through the year. And also for the Federal Reserve to continue along its path of normalizing monetary policy by raising interest rates. Now, however, in line with the fact that the economy outperformed our expectations for growth, the Federal Reserve also hiked rates more than we were expecting a year ago. A year ago, we were talking about 3 interest rate hikes over the course of 2018, and in the end, the U.S. economy was so strong, the Fed hiked rates 4 times. So 2018, certainly a good news story for the U.S. economy. Now, some of the things we didn't do so well on the forecast, we talked about a modest rise in longer-term interest rates, government bond yields. Now, we did get that through the first 3 quarters of the year, but a lot of it reversed in the fourth quarter. So with short-term rates moving up and longer-term rates not moving up as much as we expected, that bellwether of the economic cycle, the yield curve has flattened further. And another thing James talked about was that the US dollar, we expected the US dollar, which has been quite strong in recent years, to lose a bit of ground as other economies around the globe started doing a little better and their central banks started removing stimulus. In the end, the US economy continued to outperform. The Fed raised rates more than expected, and the US dollar remained strong. He did highlight that we could see trade uncertainty related to NAFTA and other import tariffs. We got that in spades, and that's also part of the US dollar strength story. In times of economic uncertainty globally, there's typically a financial flow towards the US dollar, being the currency sort of the global reserve currency, so that those worrisome moves also helped support the US dollar over the course of 2018. So overall, we had some hits and misses in our outlook, but I think overall as economists, we look at 2018 as a year that performed relatively close to our expectations. Maybe a B plus on that one as far as the outlook goes. So now that's the rehashing of the old outlook. Now what do we see for next year? So basically, in terms of themes for 2019, a big one, I think the question on everyone's lips right now is the downturn in equity markets we saw in the fourth quarter. In fact, US equity markets on Christmas Eve entered bear market territory. So questions we're getting a lot are, what does this mean? Are we headed for a recession imminently? Is the US economy slowing? So this presentation, I'm going to present what we think our view is on where the US economy is going. But one thing to point out is that equity markets are not the best predictors of recessions. In fact, they have a very spotty track record predicting recessions. Bear markets only have a 50-50 chance of getting it right, and we've had a lot of false signals in the past. In terms of years where we saw bear markets, where recession was not imminent, this happened in 2011, 2002, 1998, and 1987 were all years that saw tough equity markets, but you didn't imminently fall into a recession. And you may be getting a bit of a spoiler alert coming through in my words that we don't believe we're headed into an imminent recession in the United States. But I think in the fourth quarter of this year, financial markets looked ahead and saw that a lot of risks were coming up in 2019, and I'm going to get into those risks. So overall, for the US economy, we do see growth slowing. At the end of 2018, growth is about 3%, 3.1% to be exact, in terms of real GDP in the US, and we do expect that to slow. I'm going to show in a slide coming up. Over the course of the year, we expect the unemployment rate to remain low, and for this to support inflation of around 2%. As I mentioned, inflation momentum in the most recent months of data has lost a bit of momentum, so the Fed really can afford to be patient in raising rates further this year, and that's certainly what we've been hearing from a number of Federal Reserve Board presidents and speakers in recent days, talking about how they're very much in data-dependent mode. I'll get into a little bit about how it's a bit tricky to be in data-dependent mode when the government's shut down and you're not getting half of the economic data. But that's an entirely separate issue, but that's where the Fed is. They're watching the data, seeing how the recent weakness in financial markets is playing out in the real economy. We saw good numbers on jobless claims this morning, an uptick in federal workers seeking unemployment benefits, unfortunately, but still overall in the broader economy, a good trend. So in terms of 2019, I say there's a lot of risks coming up, and that's because we have a lot of these what economists would call event risks, things that are happening over the course of the year, and we don't really know with certainty how they're going to play out. You've got the trade ceasefire with China. The US agreed to sort of this 90-day cooling off period where they weren't going to ratchet up tariffs on each other. That's going to come to a close in the first quarter of this year. There seem to be negotiations going on. We're hopeful that the US and China are able to reach some sort of agreement so that these tariffs don't continue to be ratcheted up, and because that's a big economic risk. Also, you've got Brexit, in the headlines just in recent days. The deal that Prime Minister Theresa May negotiated with the EU has been voted down. So, but, they still have confidence in the government, so they've got to figure out something. But the deadline on that process is the end of March. So we could have a lot of fireworks coming from Europe. March 1st, the US debt ceiling is set to be reinstated. Now, the US Treasury can take extraordinary measures to keep finding money without having to incur new debt for a few months, but that's something Congress is going to have to deal with, raising that debt ceiling, and also, you see in the chart, lifting the budget caps. And I'll get into that a bit more later, but a lot of fiscal hurdles to get through in 2019, and in our new divided Congress in Washington, it's interesting to hear, don't have a divided legislature here in the state of Maine, but it's a very big issue in Washington. And, if recent days are any indication, it's going to be a tough year in terms of getting Democrats and Republicans in Washington to agree on things going forward. And final, and probably likely quite important here in a border state like Maine, you have the USMCA deal, and that's sort of NAFTA 2.0. This has been agreed on, however, it needs to be passed in Congress. And right now they're in the process of, the department reviews the deal to sort out economic impacts. Democrats have sort of reserved judgment on whether they're going to support it. It will need Democratic support to pass. And I think, once the report comes out on impacts, it's you need to be a political scientist to figure out whether that's going to go through, but that is another risk for 2019. And apart from those event risks, we also have sort of more standard risks, which economists might bucket into. You've got structural risks and business cycle risks. Now, business cycle risks are things like monetary policy normalization. I feel like that's a bit jargony. That just sort of means rate hikes. And one of the risks, I would say, which has receded in recent weeks is that the Fed would raise rates too much, stifling growth in the economy and potentially triggering a recession. I think we really have seen members of the Fed get out and speak about the fact that they're concerned about growth and that they're going to be patient on rate hikes. So that's a risk, but I think the Fed is very cognizant of that risk, and I think they're wisely moving slowly. We have a slowdown in growth in emerging markets, which is already underway. There is a risk. China has managed to slow its growth rate quite deliberately and in a predictable way. This has been a risk that's been around for 8 to 10 years. China's slowing, it has demographic challenges. The government's managed to do that, but there are risks there that could slow more dramatically in emerging markets. And one of the risks we're watching here in the United States is high corporate debt levels. And this is non-financial corporate debt. Prior to the financial crisis, you had financial sector debt. But now companies have really loaded up on debt during this period of very low interest rates. And the risk is, as rates edge a bit higher, as long as the economy's going and companies are making money, these interest payments on this debt or the rollover risk is not a big deal, but there is a lot of non-financial debt out there, so this is a risk that's being watched closely. And I won't get into Canadian debt, that's a whole separate issue, but sometimes I present in Canada. And again, the other structural risks there are high government debt loads around the world. Not just here in the US, but a lot of governments around the world during the financial crisis enacted significant fiscal stimulus to stimulate the economy and incurred a lot of debt to do so. China being one of these economies. And one of the risks from this is when we do ultimately have another downturn, it's going to limit a lot of countries' abilities to enact fiscal stimulus, to spend money to stimulate growth, because they're already dealing with these heavy debt loads from the last financial crisis, because the debt loads haven't really been dealt with since the last financial crisis. So the risk is that the next recession could be a bit more prolonged due to the inability of governments to enact fiscal stimulus. So now that I've scared you all with all of these risks, I'm going to get into where the economic indicators are playing out here. Oh, sorry, I went a little too far. So the financial indicators are not tripping the recession alarm bells yet. Now, there are a lot of squiggly lines on these slides, a lot going on. On the left-hand side, basically that's just measuring market volatility, and the solid line is the long-term average. So we've certainly seen a spike in market volatility. I don't want to minimize that, but it is not the sort of spike we see typically prior to recessions, and it even doesn't compare with the spikes we saw in 2011 with another debt ceiling situation and European sovereign debt concerns, or the spike we saw in early 2016, where markets got very concerned about Chinese growth slowing, oil prices were tanking, and that's, neither of those periods led to a recession. The other one, which of course is the most closely watched, is the yield curve. Now, the yield curve is very flat. That's the difference between yields on long-term government bonds and shorter-term ones. But again, typically this measure inverts before a recession, and we aren't there yet. And you see, one of the periods we're thinking a lot about is the late 90s. And you see there in the late 90s how flat the yield curve got, a couple of years ahead of a recession. So, the situation we're in right now is not unprecedented by any means. So, and overall, so these indicators, as I say, aren't predicting a recession just yet. And The US economic indicators remain solid. This is a leading economic indicator we calculate from a basket of various indicators. And what you can see here is that that zero line is the long-term average, and we're basically just measuring whether it's above or below the long-term average. It remains above. You can see, get out your magnifying glass, it has come down a little bit, but it still remains above average. We're just not seeing risks in the economic data yet. Now, one thing we would see is we are seeing manufacturing sentiment deteriorate. I think, rolling over might be a bit of a strong statement, but China in particular, manufacturing sentiment has deteriorated. Really after a strong showing in the first half of 2018, global manufacturing surveys signaled a slowdown in the second half of the year. In countries like France, China, Italy, Turkey, so a lot of countries, manufacturing is slowing. And this is consistent with, the weakness we've seen in commodity prices, and it's starting to affect manufacturing sentiment here in the United States. So slowing foreign demand is a headwind to US manufacturers who do export over the first half of 2019. And this is one of the worries that we're watching, is that this turn in sentiment, if it becomes self-fulfilling, businesses may not be seeing growth slow yet, but they're worried, so they don't invest or they don't hire, and that can be how you get a negative cycle there in terms of growth. So overall, I feel like I've scooped this slide a little bit, but basically the global economy slowing towards trend. It really was firing on all cylinders in 2018 and has slowed in the second half of the year. We do expect growth in the global economy of about 3.4% this year. That's a slowdown, but that's not a dramatic slowdown by any stretch. And really the sell-off we've seen in financial markets contrasts with a still relatively positive economic outlook. Now, for here in the US economy, I'm gonna get this right. This is our outlook for US growth. And in 2018, you see that 3.1%. That was heavily boosted by the fiscal stimulus. Those are those light and dark gray bars there, both the Tax Cuts and Job Act, and also the government spending boost that was enacted. And just a little bit more on that. Basically, the budget deal that was reached by Congress last year expires in the fourth quarter of this year. For the fiscal year 2020 starts on the 1st of October, and Congress is going to have to reach a new budget deal to agree to maintain spending caps where they are. Because the Budget Control Act of 2011 puts into place that if the government can't reach a budget deal, spending levels go back to the caps that were set in 2011, which at this point would basically necessitate, get the exact number, it's $100 billion worth of spending cuts, which if this were allowed to happen in the US economy would slow growth by 0.5 percentage point. So you basically have an economy that we already expect to slow to 1.7% growth. We expect this 0.5 point would take growth to 1.2, so very anemic indeed. So this isn't in our base case outlook. We do expect that Washington will reach a deal to keep the spending at least at the levels where they are now and not allow this is called sequestration to occur. But you can see, just looking ahead to 2019, the lift from all this fiscal stimulus is expected to wane, and that's a big part of growth slowing towards 2.1%. The other side of it, of course, is as the US economy digests interest rate hikes that have already occurred, because interest rate hikes typically act to slow the economy with a 12 to 18-month lag. So, we still haven't felt all the effects in the US economy of the past Fed interest rate increases. So that's also expected to slow growth. But I see my clock is running out here. I think, do I have some time for questions after this clock? Does anyone? No one can tell me? Anyway. I'll speed it up here, just a couple more slides to get through. But basically, in terms of the good news, as I say, we expect growth to continue at a modest pace. The unemployment rate remains at a generational low. You can see here in Maine now, unemployment rates at the state level are quite volatile. So in the second half of 2018, we have seen an upturn in Maine's unemployment rate. That's stemming more from growth in the labor force, and I'll get into a bit more about that in a moment, but we're not too concerned about that. And as you can see, Maine's unemployment rate quite a bit below the national level and the unemployment rate at the national level is quite low. Now, what this has driven is stronger wage growth in the second half of 2018. For a number of years now, we've had a strong labor market, but people have been disappointed by how quickly wages were growing. And in the second half of 2018, we saw wage growth pick up above 3%. You know, inflation remains fairly modest overall in the economy, even more so now that oil prices have fallen. So workers are getting some nice, decent real wage gains at the moment, which helps to support consumer spending going forward. So with this strong labor market, this is wage growth, and we have seen that local wage pressures in Maine have come off the boil a little bit. The green area is where it is in the United States. Now, this is a 12-month moving average, so you don't see so much the uptick in wages at the national level. Maine has had a faster increase than the nation as a whole, and it has come down recently. Now, this is one of the most positive stories I was seeing when I was looking at the Maine outlook, and this is migration to the state. So in the 2016 and 2017, we don't have 2018 data yet, Maine had the best years for in-migration since the early 2000s. So I know that some talk earlier about initiatives underway to recruit or retain more people in the state, but I can say, you know, you've had some early success on there. That's really encouraging migration numbers, which helps support the strong labor force growth we've seen in Maine in the latter half of 2018. So in terms of what the economic growth means for the housing market and where we see house prices going, we do expect more modest growth in home prices ahead in 2019. Looking at Maine specifically, house prices actually outperformed where we thought they were going to go in 2018, rising 5% when we were expecting a more modest increase. So we do expect house prices both nationally and in Maine to slow over 2019 as higher mortgage rates start to rein in growth. Affordability in many areas of the United States is rather stretched. But overall, our outlook for Maine's economy is for Maine to slow in line with the nation. As I say, Maine grew at about 2%. Now, we don't have data for all of 2018, so 2018 really is still a forecast, but Maine looks to be on track to grow at 2%, and we do expect that to slow to around 1.2% in 2019, and that's roughly in line with the national slowdown towards 2.1%. But again, I would just reiterate that, you know, while we see a slowing economy, we don't see a recession imminently in the outlook. You know, the economy's been growing at 3%, so it can be a little bit scary to hear about growth slowing to 2%, but we do think that the consumer with low unemployment and decent wage gains has a fair bit of room to run yet. So I see my timer's at 0. I don't know if anyone's brave enough to ask a question in this big room, but I'm happy to entertain any questions.
You mentioned residential rates. Where do you see them going?
Mortgage rates? You know, I'm up here with my TD pin on, and we're not allowed to comment on where mortgage rates are going. It would be construed, you know, as a policy statement from us. I can talk about government bond yields and the environment in general. So we do have a modest uptick in government bond yields over the next few quarters. This slide has our website there, and you can look at our detailed interest rate tables on our website, you know, 5, 10-year, 30-year government bond and where we see it. We think markets have reacted a bit. They've overreacted in terms of how low they've taken yields recently. So we do think that yields are headed higher, but not dramatically so. But at the same point, there's already been a drop in yields. So, you know, we're likely to see a bit of slowing in terms of rate pressure in the mortgage market. Okay. All right. Again, thank you very much for having me. It's been a pleasure.
Okay,
sure.
Here, so.
Yeah, the clock was only.
Well, I think we started about 5 minutes early. So.
Okay.
So we do have about 5 minutes for some questions for Leslie, and I know it's daunting to get up in front of this room. So I'm gonna sort of be the proxy for our crowd and ask a couple of questions and put Leslie on the spot here. So Leslie, can you know, we're in the middle of a government shutdown, and I know, you know, that probably doesn't have an immediate impact on Maine, but I'm personally involved in some transactions involving HUD and other federal agencies. Can you talk a little bit about the government shutdown and what you see the impacts of that, especially this year?
Yeah, that was something I didn't mention as I was getting concerned about my countdown clock there. But, you know, the government shutdown is going to hit growth in the first quarter of this year. We've already worked the first 2 weeks in January of the shutdown into our outlook. So the U.S. economy is expected to grow 1.6% in the first quarter, which is pretty soft. This continues a pattern of weak first quarter growth. They can't seem to seasonally adjust the numbers. But in terms of, as you mentioned, these individual government agencies, we do think these impacts are going to accelerate the longer it goes on. In terms of housing, I mean, Fannie and Freddie are not government funded, so they're not affected by the shutdown. The FHA, I do know that it's got multi-year funding, so it's working with a reduced staff at the moment. So these effects are going to mount as the shutdown goes on because, you know, the shutdown started over Christmas. Maybe there wasn't so much activity, but I think businesses are increasingly feeling the pinch with these areas of the government that are shut down. It is a partial shutdown. It affects 25% of discretionary spending. So when I talk about that we're not getting economic data, about half the data agencies are open. The Bureau of Labor Statistics is still open, so we're still getting employment data and inflation data. So it's a bit of a mixed bag in what's open and closed, but I think Congress is going to increasingly hear from businesses. There was a survey done by, I believe, the National Association of Realtors, and it sounded like about 25% of respondents were having issues with people, you know, pulling back activity in the housing market due to things related to the shutdown. But frankly, a lot of it was just due to uncertainty because of the shutdown. It wasn't explicitly because, you know, they couldn't transact with the government, but it was more that they were worried and thought, oh, okay, well, maybe this isn't a good time to purchase or sell a home at the moment. So as it drags on, the economic impact's likely to increase. Some of that would be made up in the second quarter as activity rebounds, but it could knock, you know, 3 to 4 tenths of a percentage point off the outlook. So it would take a quarter of growth that's at 1.6 down to, you know, 1.2 or so. So it's certainly, it's a negative for the outlook.
Thanks, Leslie. If anybody else has a question, if not, I'm going to give you one more challenging one.
Okay.
So if you can talk a little bit about trade. I mean, between what's going on with China, Brexit, the effect on the dollar, all of those things. I mean, I know you mentioned this a little bit, but if you can get into a little more detail of, you know, how do we anticipate those issues impacting the U.S. economy going forward?
Yeah, well, I would bring it back to that, if you could remember that slide I showed of manufacturing sentiment. And, you know, we've already had import tariffs levied on Chinese imports. You know, I'm coming here from Canada. We also still, in Canada, are facing tariffs on steel and aluminum. Those haven't gone away with the USMCA deal. So we have seen growth slow in China directly as a result of these tariff actions. You know, the world is an interconnected place. And slower growth in China means slower demand for U.S. exports. And we're starting to see that in these measures of sentiment. So it likely it is subtracting from growth already. The risk is, and you know, we used to have a slide in our chart deck that showed potential worsening in trade. A lot of it, I think, the worst case scenario, the Trump's threat to levy, you know, 25% import tariffs on the auto sector, which would be very severe for the U.S. economy on imports coming in from Europe and other parts of the world. You know, the real one right now is China. And I think, you know, the U.S. economy is a very large economy, very diverse. Trade is less important in terms of growth here, and it would be a negative. But we would see it also in higher consumer prices for many goods in China. So it could contribute to, we already have the U.S. economy slowing. If we get another ratcheting up in import tariffs, that will further slow the economy. But where the rubber really hits the road in terms of the negative impacts is if you get that shift in business sentiment. If businesses who are confident start to say, well, gee, you know, we've got these tariffs. I'm not sure if my foreign buyers are going to make purchases. Then you sort of get that negative cycle where American businesses, because of their worries about the global outlook, ratchet back investments or hiring, and that's where it can, turn to a further slowdown in the U.S. economy. So it is a big risk and one that we're watching closely, and we hope that the U.S. administration, doesn't make good on all of the threats that are still on the table.
All right. Thank you very much, Leslie, and we'll hope to have you back next year, and so you can report on your predictions from this year.